Happy Wednesday out there, Team 42. It's your skipper here, Darius Dell, to present another exciting episode of Pro to Pro Live. I'm joined with our friend Scott Diddel from Diddle and Diddle Wealth Accumulation Strategies. How you doing today, Scott?
I'm doing great, Skip. I'm doing great. I'm doing
It's
great.
it's
Happy to be
it,
here.
it's a pleasure to be here. So I learned in this in preparation process that your dad and I share a nickname, Skipper. Obviously, I get that from our Jackie Robinson roots. What was the root origin of your father's nickname?
Well, my dad was always kind of a commander. People just, he's kind of he could talk to kings, he could talk to kids, and people just respected him. It's kind of like the sage type of guy that just carried was larger than life and, brought this authority to how he showed up on the planet. So, kind of skipper,
I love
was
that.
something that worked well for him.
That's fantastic. I love that. Hopefully, I can live up to that billing someday. So let's just hop right into this presentation. Obviously, we got a lot of ground to cover. I'll start by introducing, why you're here, why Scott Diddle here. So we have our, as you know, our 442 macro client community that's housed within our client dashboard, where I spend a lot of time just sort of answering questions about, where the economy headed, where markets headed, and trying to debate openly and honestly with our clients across the global buy side and the global retail investor community on where to next from those perspectives. One question that came up that we don't typically focus on in our research for obvious reasons, because it's not something we were legally allowed to, but was taxes and the implications of taxes and some of the strategies and recommendations that not just us, we make, but also folks who do what I do for a living make as well. And so I thought, you being a very seasoned, very experienced, and quite good, great tax professional, and in full disclosure, Scott is a tax professional of mine, and he runs some strategies for me as well personally. I thought it'd be great to bring you on and have you give your a pitch. I learned a tremendous amount when you and I were kind of going through this presentation. I want to say 5 or 6 years ago, and hopefully the clients will learn a lot and potentially can seek you out if they have some incremental questions or want to subscribe to your services. So without further delay, give us a little bit of background about yourself, Scott.
Okay. First of all, the pronunciation would be Diddell. Think of it like farmer and Diddell. Okay.
Fidel.
Second, I've been a financial coach for 38 years. Okay. Before that, I was a professional bicycle rider, and before that, I was a school teacher. So I've always been a coach. I've always been a kind of an entrepreneur and someone who just likes to kind of create my own limits. And I just see the world as being my oyster, and I've been very, very blessed to be able to do what I want to do. So that's kind of where that is. Career-wise, I came from also my education. I grew up in New York City, a family of four siblings. We're blessed to go to the Dalton School, outstanding school for teaching kids how to think.
Wow.
I went to Bowdoin College up in Maine. It was
Okay.
a great school. And then I was a school teacher for 6 years. And during those 6 years, I did my MBA and Master of Education Studies at Columbia University Teachers College.
Yep.
And then I got into cycling, and I've cycled around the world. And actually not around the world, but I probably cycled like 55,000 miles in my time. And I led tours all around the world, and my tours were all about teaching kids how to be interdependent as well as independent, and
Hmm.
have a chance to see the world through uh, a set of eyes that just where everything's always changing. So that I love the idea of being the kind of the skipper, if you would, or the inspiration for them to become kind of learn how to grow up and become more fulfilled as kids. So then I, I met this amazing woman, and I decided I couldn't be traveling all around the world, and so I sold my businesses for love, out of love, and that was 38 years ago.
That's
So here
amazing.
we are,
Here we are. So
and I still love what I do. This
uh,
presentation is all about uh, the basics for understanding how to win in the 2024 financial marketplace, presented by yours truly. Okay. This presentation, it should be about 17, 18 minutes. And as I said, this is probably the best stuff I had over the last 38 years. And we'll see if it makes an impression.
I like it. All right, let's get into it. So what talks about slide two here? What's on slide two?
Okay, so what's most important is the turn you make in the upper the top line, or is it what you keep, which is the bottom line? We tend to say that it's what you keep that's key. That's what you're taking home. Okay? That's what you're netting
Absolutely. What do we got here?
out. Okay, Ben Franklin stated there are only two guarantees in life: death and taxes. Well, Ben and I would have a difference of opinion because we all have an expiration date. We all do. Many of us don't act like it, to include me. Okay, but sometimes. But we taxes. We believe the taxes don't have to kill you nor your financial strategies if you understand the ramifications. If you understand how you can avoid taxes legally. Okay. Uh, Tax avoidance is legal by the Constitution. Tax evasion will get you thrown in jail. Just so you know. So we advocate tax avoidance whenever possible.
Absolutely.
Okay, now this is interesting. Did you realize that tips are the greatest barriers to your financial success? Well, first of all, you have to understand what's a tip. A tip, when you go to a restaurant, you give the waiter, which is a tip, right? I call that an obligatory tax. Okay, the acronym TIP really comes from the perspective of to ensure promptness. So in the old days, you would give a tip when you walked in, so you get your soup hot and immediate. Okay, so things have gotten turned around a little bit. So I took the acronym and I said, let's make it more of a financial type of focus. Okay, so the T is your taxes, the I is your inflation, and the P is procrastination. And what you'll see there is that we all procrastinate. Some of us more, some of us less. But the question is, what do we know about taxes and inflation? So let's go to the next page. Okay, according to the Social Security Administration, for every 100 people in the United States who reach the age of 65, 5% are rich. That means they make between $500,000 and $5+ million a year. Okay, for financially fit, they make between $150,000 and $500,000. Now, on the other side of the line, you have 35 are still working, 8 are dead, and 52 are dead broke.
Wait, what? That's a ridiculous number. How do you define 50?
So here's the deal. We're not just talking about kids with education, debt. Okay, we're talking about the fact that if you have a debt issue when you're 30, it's going to be worse when you're 40, and if it's going to be worse when you're 50, and then you're probably going to be drinking on top of that. And it's going to be worse when you're 60, and when you're 70, you'll be living with your kids. That's not really the aspiration to have. So basically, 95% of people spend 45 years of their lives, quote unquote, pushing that rock up a hill. So the question is, going after the perspective early on. So education and coaching can give people a chance to start to kind of create a strategy for themselves.
Gotcha. Yeah, no, these are staggering numbers. I mean, half of the people who reach the age of 65 being broke is sad. It's obviously a political outcome, that with numbers that high, we don't have to get into the political side of this, but it just speaks volumes to, the importance of, doing whatever you can to mitigate that. And obviously one way to do it is, we're kind of on the for the tip of the spear in terms of what kinds of returns are you generating, how are money compounding in your accounts in terms of the money that you're saving throughout the course of your work life. You're on the other side of the spear, which is, let me make sure we are not paying too much of that back in taxes to the extent possible.
Yeah, well, there's on top of that, the issue is, having a plan, and they say, failing to plan is planning to fail, right? So as a result, I mean, everyone should have the opportunity to speak to a professional, have a coaching relationship, so that you've got somebody in your corner, okay? Because when you take a snapshot of what you make, the top line, we always work with the top line, because you should save between 10 and 15% of your pre-tax income on an after-tax basis. Right. The reason why it's 15% is that 10 to 15% is that on the top side, because you know exactly what you're making. When on the net bottom line, you really have no idea what you're making, only because taxes and expenses and that type of thing. So it's important that you look at the numbers, and you want to be on the upside of right versus on the yellow side of down.
100%. Let's keep moving.
Okay, so it all started here with the 1913 tax form. So before 1913, 1912, before that, you had state taxes. Okay, you didn't have Fed tax. Okay, so taxes were anywhere from 2% up to 7%. And so if you go to the next slide, so what you see is that in 1912 there were no taxes. Okay, 1913 taxes came to be 7%. Okay, then what you see within a few years, you see the First World War. Okay, guns and butter for the First World War, and taxes went up to like 65%. Okay, and then after after the war was over, after the patriation was over, the taxes went back down, but they went back down to 20%. So as a result, the question is, you know, the individual had no place to go but follow the tax trends. Okay, now come across the Second World War. If you go up to the top, what you'll see is the tax were as high as the top marginal tax was high as 94%.
Wow.
And so the way that worked is that um, and over you know 111 years. Okay, what you see is that the average top bracket was 59%. So what's important about that, as we look at the returns, when you look at our GDP. Okay, our GDP is about $18 trillion. Okay, our debt is $35 trillion. Okay, so what I believe, what I coach my clients is that I mean it's you gotta be sensitive to the fact that the tax rates have to go up. Okay, I don't care what politicians say in terms of giving tax breaks, especially to the wealthy, that type of thing, or to anybody. But his tax rates, it's kicking a can down the road, and so we can't afford that. And so because you got to cut costs and you got to raise taxes at some point in time, and there's no better time than right now.
Oh yeah, totally. All right, let's keep moving here.
Okay, so this is Professor Iverson from the University of Chicago. This is his work. So stocks, bonds, bills, and inflation. This basically talks about the fact that inflation. And keep in mind that we're dealing with inflation right now, but until 2 years ago, inflation was nothing for 20 years. Okay, a T-bill, was nothing in terms of return, and now inflation has just kind of reared its ugly head recently, but it'll come back down. So inflation, over from 1926 to 2023, 97 years, what you have is inflation. You now need $10 to buy what a dollar bought back then. T-bills, government bonds, large cap stocks, and small cap stocks. I'm going to focus on the large cap stocks and small cap stocks. What you'll see is that if from day one, if that were $10,000, okay, the large cap stock would have become 97 years later $25,330,000. But the small cap, because of the nature of the holdings, would become $129 million. And you might say, well, Scott, coach, that's $109 million. That's a long time. But I'm going to say the key thing is it's the small numbers that count. If you take a look at the difference of $109 million, it's the difference between 12.7 and 10.4%.
Wow.
That's the key. And so we're going to focus on those numbers. So for the next slide, keep this in mind. I'll go back once again. Here, 2005-33 at 10.4%. Okay. Next slide, please. Okay. Now, when we bring taxes into the equation, okay, what happens here is that stocks, the large cap stocks, that were 2005-33 at 10.4, become 672 at 8.3%. All the same moment in time, because when you look at the tax grid that we saw before, you'll understand how every time you have a dividend capital gain, you got to pay tax. It's called stealth tax, because you can't. I mean, it's getting reinvested. You pay the tax on your 1099, but you're not doing anything with the money except buying more dividends, capital gains at a public offering at net asset value. Okay, so here so here you have this, and next slide, please. Okay, so this is very telling. So after taxes and inflation being the stealth taxes, you can't see it, but you have less buying power. I mean, today inflation is less buying power in terms of when you go to the store for eggs and groceries, it's less buying power. So that's inflation. Okay, and your taxes are what they are. And so your taxes that were 2,533 at 10.4, at 672 at 8.3, become $40.28 at 5%. And so that's a 98% decrease in terms of the basic valuation for what you had. Yeah. So what we coach people on is taking the perspective of saying it's not what you make, it's what you keep. Okay, let's go to the bottom line here.
So let me run this back. So we started with ending wealth of 2,533. I don't know what these units are, but let's just hold those numbers at face value. Then you add taxes, you wind up with 672. And then you add taxes and inflation, you wind up at 48, which is how you get to that 98% decrease. So taxes and inflation are accounting for the 98% difference between your nominal return and your actual banked return.
That's correct. So if all you did was do nothing with your money except let it get eaten up by taxes and inflation, your 2,533 becomes $40.28.
Wow, that's insane. That's
but the full disclosure is that most people have no idea what they make in terms of what they net out. Because that's why you have accountants. If the United States did what the Brits do, where they charge you 15%, the accountants would be out of business.
Yeah.
Because if you make $100,000, you're paying 15%, $15,000. Good night, you're all set to go. But our tax codes are kept to be so complicated, so that so the accounts are needed, and they got to stay in business. Then you throw the IRS in the equation, because so they can track out what the story is. Again, if you did what the English did, 15% tax, everyone would be happy. Everyone would pay their taxes, and there's no getting around it.
Yeah, I'm a big fan of the flat tax myself, but I always go back and think, the founding fathers, the folks who have been most instrumental in creating, our constitutions, our public institutions, taxes, et cetera, they're capitalists. This is a capitalist society. So we should not be surprised that capitalists have created, tools and techniques and institutions that allow them to inflate their income and wealth. And obviously, accountants being one of those biggest trades and biggest professions.
I agree. But and I'm a capitalist. I mean, I like being an entrepreneur. I like creating opportunities, and I like making money, and I like giving it away.
Totally.
Out of a kindness gesture. Okay, but I like the idea of being more in control than being out of control. Okay, and so I've just traveled the world, and I've seen how different cultures work, how some work very well and how others don't work well at all. But being in Hong Kong for quite a while, I love the fact that everything was 15% worked for me. And so it'll never happen here. It'll never happen here. But there's something that truly did impress me.
If the poorest rich person can save $1 on taxes, they will hire an accountant to do that.
Yeah,
it's not going anywhere.
But Skip, what I believe is that if everyone had to pay a tax, everybody had to pay tax. If you didn't have the cash, then you push a broom. Okay, if work fair. If everyone had to become an American, if all Americans had to do civil service, 2 years of civil service, and nobody could get out of it. So you start to appreciate how amazing America is. Okay, and then you support the country that you come to know and love. Guess what? All of a sudden you have the best country in the world. So supported by a population base that truly understands who we are and what we've been through.
I'm a big fan, man. Let's get back in this presentation, though.
Okay, so here's Rockefeller. Okay, John D. Rockefeller, and he says don't pay tax on growth you're not using for current consumption. So what that basically means is don't leave a lot of money sitting in a bank doing nothing except paying for the staff and for the brick and mortar of the building. Okay, so that's doing nothing for you. It's kind of eroding your capital base because if you have your money in a bank and you're making 3%, 4%, your bank will lend me your money at 8 or 9%.
Oh, yeah.
And so if you could somehow be your own bank, and if you could, it's like looking at the you know the differentials on 12.7 versus 10.4%. Those 3.3% number. Okay,
Oh, yeah.
And you became your own bank. Then guess what? Then now you're in a position of power. Okay, and Rockefeller, he instead with Standard Oil, he knew how to make a buck, and his bucks are still carrying forward with the way they set up trusts and using insurance vehicles.
Totally. Keep moving.
Okay, so the wealthy invest for tax-free income, for tax-deferred growth, for long-term cap gains rather than basically ordinary income tax. Long-term cap gain is 20%. Ordinary income tax right now is 37% at the high point.
Am I dating myself and not knowing who these two folks are?
What's that?
Am I dating myself and not knowing who these folks are?
No, you're not. There's people who are from the Midwest, Ethel and Fred, and I like their, Joe and Joanne America.
Gotcha. I like it. I like it. I like it. Keep moving here.
Okay, so what we did is we created to kind of levelize the playing field. We created the integrated tax efficient retirement planning model. Okay, now let's go to the next page. Okay, we believe I've been doing this for 38 years that you have three buckets. Okay, your tax later bucket, that's your qualified dollars. That's SEPs, KIOs, IRAs, 401ks, safe harbor plans. That's all qualified dollars. That means the dollars go in pre-tax, they compound tax deferred, and then when they come out 100% income taxable. Okay, many people don't know that. They think it's a long-term cap gain when it comes out, but it's 100% full income tax.
Oh wow, I didn't know. Yeah.
Okay, so that's very important to know because with this is kind of a kind of segue back with the debt that we have, the $35 trillion of debt. Here's what's going to happen. Okay, the government controls the tax deferred dollars. Okay, tax later dollars. They control that because they control the taxes, everything else. So that when it comes time to raise taxes, the low hanging fruit are the qualified dollars.
Yeah.
Okay. First of all, if you think they're your dollars, they're not. The reason being, if they were Skip, if they were your dollars, what would happen is that you could take them. Well, if you're 30 years old, 35 years old, you need another lifetime to be able to access your money. A lifetime, 25 years.
Yeah.
It's a freaking lifetime. And so you get growth. And the more growth you get, the more taxes you're going to pay.
Yeah.
And you can't access it. And if you want to take it out for if you have a 401k, if you want to take it out beforehand, you can take it out up to 50%. But the problem there is that when you pay that 50% back, which you have to do, you pay it back with after-tax dollars. So you pay it back with after-tax dollars, and so those dollars are double taxed.
That's a double tax, yeah.
Double tax, big problem. That very few people really understand how it works. So the low-hanging fruit for the government the tax later dollars, the risk of qualified dollars. Gotcha. And that's something that people ought to be made aware of that because it's like taxes were as high as 94%. The average tax has been 59%. We're currently at 37% tax bracket. And so the reality is taxes will have to go up, and the low-hanging fruit on the qualified dollars is where those dollars are going to come from. Because the government controls all that.
Yeah, they might go up a lot sooner than expected. I mean, we've done a big deep dive empirical study on economic and market dynamics that occur during fourth turning regimes. And one of those conclusions was government revenue as a percent of GDP tends to have a market increase during fourth turning regimes. They're likely to be in one for another 8 to 10 years. And so at some point, we might be faced with an existential enough crisis to weaponize the public sector balance sheet in a way to deal with the crisis. And obviously, the easiest way to do that is to turn the taxes up, turn the tax dial up, and issue more debt. We're probably going to see quite a bit of both as we progress throughout this decade or into the early part of the 2030s.
Yeah. Well, and so as a result, that tax is a heinous tax because it's just going to happen.
Yeah.
Because they're multi-trillions of dollars in qualified accounts, and that's how they're going to get it. Okay, and that's what's happened in the past. So I'd be, buyer beware of that. The next bucket over there is tax now account. That's your outside investments, stocks, bonds, mutual funds. 12 months in a day, if you hold an asset portfolio is a long-term cap gain, and that's 20% today. 12 months minus a day, it's a short-term gain, and that's your ordinary income tax rates. Okay, so it's important to understand how the timing of that works. Okay, so that if you trade a lot, you're paying short-term gains. Okay, on your portfolios. If you buy and hold 12 months in a day, then you have a chance to pay lesser tax. Okay, going forward. Okay, so next we have tax once and never again. So this is an acronym that I use. It's called a LIRP, Life Insurance Retirement Plan, where the dollar's going after tax, we pay tax once. Because I believe that right now we're having a tax sale right now because I believe that taxes will never be less than they are right now. They won't be less than that. They won't be less than what they are right now. So if you have an asset and say, I mean, if you can pay tax now and never pay it again, okay, and have it in a plan where you're not paying tax as it's compounding, okay, and then in that plan, part of the plan design is that you never pay tax on the way out, and then because it's an investment grade insurance product, you never pay tax on the legacy side of the equation. So it's basically triple tax free. Okay, so that's a strategy that we like a lot, and I've done a lot with that type of planning over the last 38 years.
Yeah. So it sounds like, if I can summarize this like simplistically, if you're in a qualified plan or the bulk of your assets are in a qualified plan, you are subjecting yourself to the risk that taxes may go up over time. If you're in a LIRP, life insurance retirement plan, you're essentially saying you're making a bet that whatever your tax rate is today, it'll probably be higher in the future. Therefore, you might as well take advantage of the quote unquote tax sale and have your assets compound tax free and take the distributions tax free once they're able to be dispersed. So that's essentially the bet a lot of investors are made. I hardly ever hear anything about LIRP. I hear everything about qualified plans, and obviously we have clients and assets that are investing with respect to short-term and long-term capital gains. This seems to me, when you're talking to investors, the bulk of the assets are kind of in the first two buckets, whereas not very few assets are in the latter bucket. But from my perspective, and this discussion we had on taxes and where taxes have been historically and where they are today, and we layer on our fourth turning regime analysis, it seems like the obvious choice here is the LIRP strategy. Am I coming to the right conclusion?
Well, and Skip, that's a very smart perspective, because it's the two buckets was what accountants and the investment population focus on. Okay, our side of the equation is you need all three buckets to make things work. The LIRP is a genius idea. And I'm not saying I'm a genius. I simply happen to use it quite a bit. Okay, that's kind of a core belief structure that if I can pay the tax once, what I call a tax sale perspective today, and never pay that tax again, and then have lifetime income coming out of that tax free, then I mean, there's no other investment out there that can really match that. Okay, because the more you make on the tax qualified side, the more tax you're going to pay. Done. Okay. The more you make on the outside investment side, the more tax you're going to pay. Done. Okay. The I use I mentioned the idea of the barbell, okay, barbell concept, where you have your bar, okay. The bar is that's what holds the weight, okay. So that's your safe money, okay. That's the bar. On the outside, you have your weights, and that becomes your alternative investments. That's your equity positions. That's your crypto positions. The positions that are equity based and growth based. But when you push that bar, what happens is that if the if the assets on both sides of the bar fail, or they will fail at some point in time, and the bar itself doesn't fail because there's no downside. Contractually, there's no downside, and there's upside that is not capped. And when it resets on the upside equation. I mean, it's a complicated conversation to have, but the game plan is such that you can use a LIRP and you can squeeze down the cost of insurance. Okay, let's think of this as an IRB. Okay,
It's an IRB. You're throwing acronyms at me now.
yeah, and another acronym for you. Okay, insurance retirement benefit. Okay, so what we're doing here is that we're squeezing down the cost of insurance, because most people think of insurance as being a lousy investment because the cost is too high. Well, yeah, it can be, because you can have a lot of death benefit and raise the cost. But what if we squeeze the death benefit way down and then pumps up the cash? That's a great strategy, because you minimize the cash, minimize the cost, you minimize the commissions, you minimize the cost to keep the product. Okay, and by doing that, you've created a game plan that's flexible, that you can kind of clutch shift money into it. Okay, and then you can use that money throughout your lifetime. You don't have to wait until you're 59 and a half. You can use that money throughout your lifetime to benefit yourself, your family, vacations, and the cash is available to you when you want it. So that's what most people don't understand about insurance. Insurance,
Gotcha, yeah.
the way we look at it, is not about dying. Okay, in 38 years, I've lost 4 people. So what does that mean? I probably have $1 billion of insurance walking around in different cities. Okay, $1 billion. I have probably $400 million of cash surrender value out there. Okay, so people can use these assets. They don't have to wait. I mean, you can have an asset where you're overfunded, and you can get access to that money a couple of years down the way. If you got you've got son Jackson, this is one of the best game plans for education plans for him. Because dollars going after tax, and compound tax free, come out tax free. There is no disclosure on insurance for FAFSA forms. Okay, nobody knows about that, and you've got the capacity to be in control. The insurance conversation is about you being in control. That's the story.
I like it.
And so as a result, what happens there is that you can pick your funds, you can pick your investments, you can benefit from how much you put into the plan. You got flexibility, and you've got the capacity to create a wealth pool for yourself that's all tax free. And that's what most people should understand about insurance, because for us, it's not about dying specifically solely. It's about living tax free.
Well, the second best investor of all time is in the insurance business, Mr. Warren Buffett. And
Yeah.
I presume he's in the insurance business for a reason. He understands that if you play the insurance game correctly, there's a tremendous amount of money to be made. So obviously, that's one thing you specialize in. You said you have clients with $1 billion in life insurance assets, $40 million in cash surrender assets walking around the planet right now. So that's really impressive. Talk to us. Let's keep the slide deck moving.
Okay,
How do they achieve those outcomes?
So here's how this works. The retirement distribution is without a LIRP. Okay, the desired distribution is $250,000. Okay, how we get there with the return that we make doesn't make a difference. Okay, that's saying at 65, we want to be able to take out $250,000 a year. Blah blah blah. Okay, So on the tax later side, if the idea is that you're going to do what everyone does, and they can load money into their 401ks. And by the way, with the 401k, always take the match. Don't put any more money into that. Okay, but always take the match on the 401k. Here, so if for 250, if 200,000 bucks comes out of the tax later account, you quote for okay, at a 35% tax bracket, that's 70,000 bucks. Okay, the net distribution to you is $130,000. So the tax now account, okay, is 50,000 bucks comes out. The long-term cap gain is 20%, so that's a $10,000 tax. The net distribution is 40, and so the after-tax to you is $80,000 less, and it's $170,000.
No.
Okay, and that's at a tax sale basis today. Okay, if taxes go up in the by 10% in the tax later account to 38.5%, that's going to affect the net distribution to you in a significant way. It's very much like looking at the 12.7, 10.4% on the Iverson graph. Okay, those little numbers may have a huge impact.
Totally.
Okay, so if we go to the next next page, so all we've done here is we've just brought in the third bucket. Okay, you have your tax later, tax now, and tax once, never again bucket, the LIRP. Okay, so from the on the tax later side, we're not taking out 200,000 bucks, but we're taking out $100,000. Okay, from the qualified plan. Thus, your tax bracket that was 35 is now 32. Your taxes has gone down, and your net distribution has gone up. So once again, it's like 35% versus 32% has an impact, a significant impact on your taxes, on what you net. It's all about the net, it's not what you make, it's what you keep, right? So on the tax now side, we've same thing, nothing's changed on that. 50,000 bucks, 20% long-term cap gain, 10%, $10,000 in tax, $40,000 net distribution, and you got that. Now the LIRP, okay, the LIRP side of the equation is that now 100,000 bucks comes out of the LIRP because keep in mind we want 200,000 bucks coming out. So 100,000 now is coming out of tax later, and now 100,000 comes out of the LIRP. Now, but for the LIRP, you've already paid tax once and you never pay it again. So the distribution to you is a net $100,000. So the genius behind this plan is that with this weave, it's like you need 3 strands to make a weave. With this weave here, what you get is that the after-tax net to you is $208,000. And so you've created $38,000 of excess cash, and that's all tax-free. So that over a 20-year period of time, Skip, what you're looking at is $760,000 found monies. And that's simply on one snapshot for what you can do in terms of wealth accumulation and keeping more of what you make. It's not what you make, it's what you keep, right? So that's found money.
I love how thorough this is. You still have more slides. One, I mean, in my opinion, you can stop the slide deck here, and this is an obvious sell in terms of obvious yes in terms of obviously the benefits of adding a LIRP strategy to an investment retirement account. But you have more, so I'm going to continue clicking slides. But that's really impressive. This is as good as an explanation on how to create a strategic, defensible retirement pool that I've seen out there. I've obviously talked to different, financial advisors. Thousands of financial advisor clients around the world, and this is something that we've had discussions about. But I've never really seen someone explain how to piece together the different components of investing from a tax standpoint. Tax later, you got your tax later bucket, your qualified plans, your tax now bucket, anything, your fund money, your trade money, and then you got your LIRP strategy. And when you put those things together, you're obviously creating much better outcomes for distribution standpoint over the long term.
Well, see, and that's the whole thing is that people don't understand. See, it's the disinformation or misinformation that's out there because insurance guys want to sell a lot of life insurance. Mm-hmm. Okay, that's how they make an income. I want to sell the least amount of life insurance.
Oh yeah.
So that when I sell the least amount of life insurance, you, the client, has the most amount of upside.
Oh,
Okay, and this way you kind of clutch shift money from the taxable side into the tax-free side,
yeah.
and watch that grow. Because keep in mind too, you get a proactive growth strategy on this. Okay, because it can be invested in equities within the plan under this tax-free umbrella. So under this tax-free umbrella, what you do is you basically watch this grow over time, and it resets every year, and so that once it resets, it can never go down. And so as a result, it's a defensive play because you can never lose money. But it's also an offensive play in terms of making income. It's kind of like you in college. You probably played football both ways. I played at D3 school. I played offense and defense.
Yeah. I don't know if we're doing that in D1, but we continue. No.
All I'm saying is that here you got the capacity to clutch shift money from one side to the other side. Once you put it into the LIRP, okay, or the IRB, or the life insurance plan, the investment grade plan, um, it's protected, and creditors can't get it.
Mm.
Okay, not that I've ever had a creditor issue, but that's part of the deal in terms of sacrosanctness of the plan. So the bottom line is that you have what I call the best of all worlds. I mean, this is not a get rich quick plan. This is a get wealthy slow plan. Okay, although if you need the money in 2 or 3 years, take money out easy. Okay, there's no qualification on it. A qualified plan means you can't take that money out until you're 59 and a half without a penalty of 10% and tax and 100% taxable income on top of that.
Mm-hmm.
Here, use a tax sale basis. Okay, pay tax once, never pay it again, and then let that grow, and then just keep funding it. Keep funding it. The more you put into it, the more you're going to have growth for you, and the more is going to come in.
I have a question, and this is probably a question for individuals having individual conversations with you or folks who do what you do. But is there a general rule of thumb, and say no if the answer is no, about how much an investor should allocate to each of these three buckets?
That all depends. Keep in mind that with 401ks, that's all done pre-tax, so that it leaves your account, and you never even see it. Okay, that's just in there. Okay, and generally, if there's a match, you take the match up to 3%, 4%, whatever the number is. But all in, Skip, is that if you look at 10 to 15% all in for what your pre-tax income is, to include, again, I like to play the 401k down because you have no control, and that's going to be the biggest liability for you because that's what your tax are going to come out of, and the government's in control, not you. Okay, I want you, Skip, to be in control of your money. Okay, and know that you can plan based on that. The 401k you can't plan. Okay, but listen, if they offer you a match, take the match always. Okay, on the tax now side of the equation, you mean I wouldn't. I mean, I'd kind of keep maybe 6 months of asset in an account so that takes care of anything on the home front that you need. And then on the LIRP side, I'd put as much in as I could and keep the costs down, maximize what you got. That's simply an after-tax wealth accumulation strategy. Okay, and the more you pay yourself, the more is going to come out on a net basis. And so, as I said, qualified plan, you have to wait till you're 59 and a half. Okay, here you don't have to wait at all. But you want to let this grow for 3, 5+ years, so you have the benefit of compounding on the asset. But I like the fact that, again, I want to be in control. Okay, and I coach my clients on being in control of their assets, so they can keep more of what they make, and that kind of gets back down to the whole premise, not the whole circle of the fact that it's not what you make, it's what you keep.
I like it. So let's keep moving here. Thank you for answering that. I think those are going to be
Okay,
personalized conversations that folks are going to
so here,
have. So.
do you truly appreciate where you are now? Well, we've known the history of marginal tax brackets have been 59%. we're currently in a 37% bracket, $35 trillion debt, $18 trillion GDP. The stuff's going to hit the fan. The stuff will hit the fan at some point in time. And they didn't ask, you know, well, here's the story. If you looked in like 1980, where it was flat, okay, that was Reagan's too much government, too much tax. So it went down to 28%. And then you have Bush's "I won't raise taxes" tax that was there. Okay, it's kind of step up there went from 20 to 33%. Then you have Clinton's "I will raise taxes," and once again, then you have Bush's tax down here, and then you have Trump. Trump's he's riding the same coattail from the last administration for what you have. So I just don't trust politicians. I don't. I don't. I don't care I don't care what party you're affiliated with. I got a problem with the fact that there's a lot of talking heads, and they're willing to kick the can down the road because it'll be my grandkids, your son, you and your son, and your kids who will be forced to deal with this.
I mean, you look at where wealth inequality and income inequality statistics have migrated, and we're essentially back to the kind of pre-Great Depression era of income and wealth inequality here in America. And so you think about the average voter, the median voter is going to say, well, let's not tax myself. Let's tax the quote unquote rich people, all the folks with the quote unquote trillions of dollars of untaxed capital appreciation in their qualified accounts. That, if we're ever going to see a significant rise in taxes, to me, that and corporate taxes are going to be the obvious solution, because that's not where the median voter feels it in their wallet. And this is why, in our opinion, that those are two of the reasons why we've seen such a dramatic lurch to populism on both sides of the aisle. I mean, you can hardly tell their policies apart. They obviously are very different people and have very different social policies. But when it comes to taxing and how they are supporting incomes and how they are funding the government, the populism has become the dominant sort of party across both sides of the aisle. And that's something that's only likely to continue and get worse before we get better as it relates to this forward turning that we're in.
Yeah, I mean, and Skip, that's a very good point. I mean, the wealthy spend so much time getting, defending their cash and not paying tax. Pay tax, because we have a country where we have $35 trillion of debt. Pay tax, okay? Churches, okay, pay no tax. Schools pay no tax, and a whole bunch of organizations that with the lobbying power of the politics, they pay no tax. I'm saying that if everyone had to pay some type of tax, if you don't have the cash, push a broom. Okay, make a difference. Make a difference in what you're doing. Okay, so what you've got is a situation that there's everyone's participating in some capacity, and rather than spending a lot of money trying to figure out how to protect, how to hide your assets, pay tax, pay 3%, 4%, 5%. And it'll make a difference. And remember, we talked about those little numbers. Those little numbers make a difference. And when you multiply that times, billions. Keep in mind, $1 trillion as 1,000 billion. 1,000 billion. 1,000 billion. That's a lot of money.
I appreciate you doing that, by the way, because I've gotten so numb to the word trillion over the past 4 or 5 years, just post-COVID and all the fiscal and monetary largesse we've seen, that I remember in 2020 doing exactly that. Man, that's 1,000 billion. And now $1 trillion is the new billion. Like what we used to think was $1 billion 10 years ago, it's now $1 trillion, and that's called inflation, folks.
Yeah, and so $1 trillion is 1,000 million.
Yeah,
and it's like crazy. Anyway,
we're brushing up on
this slide.
Here. So let's wrap up.
This slide here, in 2005, the 10-year Treasury was paying 4%, which is pretty much what it's paying right now. Keep in mind too, for about almost 20 years, there was no inflation. Okay, and the T-bill was at about like 1 or 2%. Now it's 4 or 5%. Okay, So, what this slide shows you is that, let's say you buy a car, okay, and let's say the car payment is $900 a month, okay. You would, which is $10,800 a year. You would have to have, if you paid this from savings, you'd have to have $270,000 of savings at 4% to pay $10,800 a year.
Mm-hmm.
So
Yeah.
you talk about what that looks like, okay, and how it's kind of like Never Land from the perspective of no one's got that. No one's got $270,000 to pay that. They're going to pay it out of income, right? And so when they pay that out of income, your net is even less, right, in terms of what you can do with that. So I'm saying that it's just a snapshot of really the kind of the multidimensional side of where money is, the energy about money. Okay, the energy and the velocity of wealth in terms of what's incorporated with that. Okay, and so that's just a quick snapshot of how you going to get there. Do you know your numbers and how you're going to get there? Okay, and so the bottom line being that it's worth thinking about. So as we come in for a landing here, whatever you decide, do it now rather than procrastinate and miss the opportunity. Because we all know that we procrastinate. Okay, we all do. Okay, but the key side of the equation is saying if you can have a focus on making a difference in your life, of paying yourself first. Okay, I use that all the time with clients. Have not really talked very much about that today, but pay yourself first. Pay yourself first. Many of us who own businesses, we pay ourselves last. Okay, pay yourself first. If you make $1, take 10 to 15 cents of that dollar and put that away. Put that into your LIRP. Okay, and so you have that working for you, and you've got the bottom line being, you know, that's how you start to build. That's how you start to build a castle. Okay, that's how you start to build it, brick by brick, brick by brick, stone by stone. And so, as you build something that's going to be, um, that works for you specifically because you're in control. You pay yourself first. It's not what you make; it's what you keep. And if these punchlines kind of stick with you, saying, "Gosh, for me to be successful, okay, and for me to be in my 30s, and saying, for me to be a very wealthy man down the way, and have my family taken care of, my kids taken care of, and I'm living the type of life I want to live. You got to plan, okay? You got to plan. Have to have a strategy. You have to have a plan, and you want to be in a place where you can make a difference.
I love that. And this has been a great presentation. I'm glad you created such a very clear, cogent, sort of roadmap for what a good, thoughtful plan might look like. And for those of you who are sort of, kind of thinking about their own investment situations, their own tax situations, and things of that nature, and you're a little bit lost and maybe realizing, hey, I probably aren't thinking about this as thoughtfully and planning as well as I possibly could have. Obviously, look up folks like Scott. Scott, where can folks go to find you if they wanted to get in touch with you, learn more about your strategy?
Well, first of all, we're on a marina in Stamford, Connecticut. We're right by the dock. You can find us at www.diddel.com, Diddel.com. Yep. I'm Scott at Diddel.com, SCOTT at Diddel.com. If you wanted to speak to a live person, it's again, Stanford, it's 203-708-9033, 203-708-9033. And my cell, 203-249-3121, again, 203-249-3121. And just as a shout out, and as a credit to you, Skip, for putting this on. I hope that you people in the audience will have a chance to take a look at what they're doing, okay, and saying, I can make a difference in my life if I get a strategy. And whether you call me up, which would be an honor for me to talk to you, or you're in a place where you can talk to your own guys. I mean, I'll give you two things to tell them. Write these down, okay? 7702A. These are tax codes, okay, and 72 5E, 7702A and 72E 5E and 10E. Okay, those are the tax codes that talk about how you can have an accumulation plan using a LIRP, using an insurance product. Okay, so if your accountant doesn't know these, then talk to somebody else, because most people don't know these things. I discovered these 37 years ago, 38 years ago, when I was looking at designing plans and being able to legally take the tax amount out of the equation. And I looked up the Internal Revenue Code rulings, and I said, here's how you do this.
Yeah.
Here's how you do this. You take after tax dollars and use, and under these codes, under the insurance wrap, that's all supported by the insurance lobby. Okay, that's supported by politicians, because they own these big plans. Okay, politicians are not going to shoot themselves in the foot. Okay,
No.
so
I guarantee you, every politician in DC is already maxed out as much as possible in this stuff. Nobody is more incentivized to game the tax code than those guys, because they're designing it and they can trade on it. So that's a topic for another day. But I'm very grateful for your knowledge, and obviously your service, man. You have your great spirit. You appreciate the little things in life, and that's something that I've always loved about you. So definitely, you guys are interested. I highly recommend checking out Scott, giving him a call, looking him up, shooting him an email, and we'll look forward to we'll catch you guys back here.
Okay. Yep. Thank you, and it's been an honor, pleasure, and a privilege to spend an hour with you.
Likewise, brother. I appreciate you.
Anyway, all the best. Cheers.